Welcome to Investment Discovery. Today we're going to take a look at how US presidential elections affected the total stock market and S&P 500 index in the past 90 years. According to the 2019 Dimensional Funds report, the market has been positive overall in 19 of the last 23 election years from 1928 to 2016 and only showing negative returns 4 times. This is how S&P 500 index looked like during each US presidential term. S&P 500 index returned an average annual gain of 11.28% during election years. At the same time, it had an average annual gain of 9.88% in the calendar year following a presidential election. Based on presidential election cycle theory, year 3 of a president's term is usually the strongest year for the market, followed by year 4, then second, and finally the first. And a word of caution, past results don't guarantee future performance. And recessions aren't always predictable, so investors cannot rely on these patterns to time the market. Here you can see the historical impact on the first presidential year, which is usually not the strongest year. Let's take a look at historical data on the impact of recessions and significant economic factors in the history on the US total stock market index during many presidential terms, which made the market very volatile and unpredictable. Now let's switch to historical data of S&P 500 index and investment horizons. The S&P 500 index data shows that while positive performance is never guaranteed, investors ought improve over longer time investments. You can see that based on the overlapping period of 1926 to 2018, market's performance for 10 years period investments were positive, which is about 94.7% of the times. Checking the data on negative returns, you can see that short-term investments, for example 1 year, has a high chance of returning negative, which is at 24.8%. And after that, intermediate terms for 5 years, 12.3%. And for the long term, 10 years, the chance of negative return is very low at 5.3%. What this means is you need to prepare yourself mentally. If you're contributing a certain amount of money for, let's say, retirement, you have 25% chance of having a loss within 1 year. So you need to stay the course. On the positive side, the average annual return since S&P 500 index inception in 1926 through 2018 is approximately 10 to 11%. Originally it started with only 90 stocks. The average annual return since adopting 500 stocks into the index in 1957 through 2018 is roughly about 8%. And here is how the annual return looked like from 1958 to 2018. Now the question is, are you expecting the typical 10% annual return? Well, think again. According to data furnished by LPL Financial, stock market rally produces the long-term average return in a given calendar year. The S&P 500 index had a return within this range in only 6 of the past 93 calendar years. Also, for 90 years, S&P 500 returned a loss of less than negative 10%. This is another look at the annual returns. Feel free to pause and read. Negative returns marked with red arrows. And any year below the average return is also marked in this table. Thank you for watching. Please don't forget to subscribe and comment any questions that you might have.